Hi, welcome back to Fi News, and before we dive into today's topic, don't forget to subscribe to our channel for latest in finance, tech, AI, crypto, and global affairs.
All right, we're kicking off the final month of the year. And, well, to put it mildly, the markets are feeling pretty on edge. You can almost feel this sense of nervousness among investors. A real risk-off mood as a whole flood of uncertainties is hitting all at once. So, let's just dive right into it. So, you gotta ask, right? What's really behind all this anxiety? It's not just one thing. It's this mix of really high-stakes questions swirling around everything from technology to economic policy to global stability. And that's exactly what we're going to break down right now. So, the big theme for the start of the month is fragility. Yeah, after a pretty solid run, we're starting to see some cracks appear. And sentiment is, let's say, shaky. Let's take a look at how this all played out right at the end of November. Now, what's really interesting here is the split you see on this chart. The broader S&P 500, it managed to squeak out a small gain for November. But the tech-heavy NASDAQ, it actually finished in the red. And that kind of divergence, well, it's often seen as a bit of a warning sign. It kind of suggests that the big tech companies that have been driving all the growth are starting to lose some steam. And that could point to some weakness just under the surface of the market. And look, this isn't just some vague feeling in the air, right? There are specific, concrete worries weighing on investors' minds. We're talking about that fragility around AI and tech stocks, a really sharp pullback in crypto, a wave of economic data that could sway policy, and maybe the biggest of them all, this huge question mark over who is going to lead the Federal Reserve next.
And if you want a perfect example of this volatility, just look at Bitcoin. I mean, for a lot of last week, it was trading pretty comfortably above $90,000. And now? It's all the way back down to $86,000. That's a drop of over 4% in just a few days. It's a perfect snapshot of that nervous energy that's just rippling through the riskier assets right now.
Okay, so let's shift gears to what is, arguably the single biggest thing driving all this uncertainty, the future of the U.S. Federal Reserve. A change at the top could mean a huge shift in policy, and President Trump is keeping everyone in suspense. And there it is, straight from the president himself. He says he's made his decision, but is keeping his cords incredibly close to his chest. He has, though, made one thing pretty clear. He expects his nominee to deliver rate cuts. And that signals a more dovish policy, which really just means a focus on lower interest rates to get the economy humming. So who's the mystery pick? Well, while nothing's official, the overwhelming consensus, the smart money, if you will, among market watchers is that former economic advisor Kevin Hassett is the one who's going to get the tap. In fact, markets are already kind of reacting as if this is a done deal. But here's the catch, and it's a big one. A more dovish Fed creates this classic dilemma. On the one hand, sure, rate cuts could be just the fuel the economy and the stock market need to power into the new year. But on the other hand, cutting rates when inflation is still hanging around 3%, that could be like pouring gasoline on the fire, creating much bigger problems down the line. It's a really precarious balancing act. And you know what's crazy? Despite all those risks, just look at what the market is betting on. Investors are almost fully pricing in a rate cut as soon as this month. This just raises the stakes for the Fed's next meeting immensely. Because if they don't deliver, well, it could trigger a pretty serious market tantrum. All right, so let's zoom out from U.S. policy for a second, because all of this isn't happening in a bubble. There are some major geopolitical events unfolding right now that are adding another whole layer of complexity and nervousness for global markets. Yeah, right at the top of that list are these super delicate and really complicated peace talks happening around the war in Ukraine. U.S. and Ukrainian negotiators have said that recent talks were productive, but a final deal is still very much up in the air. There are just so many moving parts. And the diplomatic dance is incredibly complex. You've got the U.S. Special Envoy heading to Moscow, you've got parallel talks happening between the U.S. and Ukraine, and you have President Zelensky meeting with European leaders like Francis Macron. But here's the really crucial point. For those core talks between the U.S. and Russia, European leaders are not at the main negotiating table. So, what's the holdup? Well, it comes down to what the source material calls the stickiest issues. I mean, these are the really tough nuts to crack. We're talking about fundamental disagreements over things like territorial concessions and what kind of long-term security guarantees Ukraine will actually get. These are the core obstacles standing in the way of peace. And hey, it's not just Ukraine. You've also got to keep an eye on Venezuela, where President Trump seems to be sending some mixed messages. On one hand, he's warning Americans to avoid Venezuelan airspace, but at the same time, he's revealed he's had a phone call with President Maduro. It's just another fluid situation adding to all that global uncertainty. All right, so we've talked about the big picture.
Let's bring these huge macro themes down to the company level. How is all this uncertainty and volatility actually hitting specific stocks you might know?
So remember that crypto slump we talked about? Well, here's what it looks like for actual stocks. Companies like Coinbase and Marathon Digital are seeing some significant weakness. And the direct cause? It's news from China's central bank, which just announced it's ramping up a crackdown on what it calls illegal activities related to virtual currencies. And that, of course, is spooking the entire sector.
And then you have this wild story coming out of the aviation world. It all started with a terrifying incident. An Airbus A320 jet suddenly pitched downwards mid-flight with no input from the pilots. Engineers frantically scrambled and traced the cause to this bizarre software flaw, apparently related to a sensor misinterpreting cosmic radiation. The report actually called it a solar array infection. This discovery then triggered a frantic, weekend-long global effort to update the software on almost 6,000 A320 jets before they could fly again.
Now, the good news is that swift action from Airbus and airlines around the world meant the vast majority of these planes were fixed in time, which avoided a massive travel meltdown. A major crisis was definitely averted. But it is a stark reminder of how reliant we are on complex software. And for a manufacturer like Airbus, an incident like this can really shake investor confidence, even when disaster is avoided.
So that's where we land. It all comes back to this one central tension. On one side, you've got the hope for a dovish Fed, which could kick off a year-end Santa rally. But on the other, you have all this geopolitical instability, tech fragility, and the real risk of inflation coming back. Which way those scales are going to tip? Well, that's the big question hanging over a very, very uncertain December.